Welcome to the Pro Ticker Deep Dive. Imagine delivering what might literally be the single greatest earnings report in corporate history.
Oh, without a doubt.
Right, like you pull in $81.6 billion in a single quarter.
It's just an absurd number.
It really is.
Yeah.
And you post profit margins that, honestly, they just defy economic gravity. You authorize an $80 billion share buyback, and on top of all that, you offer forward guidance that just completely shatters every expectation on Wall Street.
You're basically telling the market that the money printer is running hotter than ever.
Exactly. And the market's reaction to this absolute perfection, they immediately slash your stock price by 17%.
Yeah, it is, it's the ultimate market contradiction right now.
Yeah, it makes no sense.
It really doesn't. You have this situation where a company has fundamentally rewritten the rules of corporate growth, and yet the people holding the stock are just violently hitting the panic button.
Yeah.
It leaves anyone watching this space completely bewildered.
So that is our mission for this deep dive today. We are going to jump right into the mystery behind this sudden, sharp sell-off that's ripping through the artificial intelligence and semiconductor sectors right now in June 2026.
Right.
We are going to figure out why staggering revenue numbers are suddenly like a liability.
Yeah, which sounds crazy to say out loud.
Completely crazy. We're also going to uncover a hidden real-time metric that's acting as the canary in the AI coal mine.
That part is fascinating.
It is. And finally, we're going to look at how a massive supercycle in memory chips is squeezing global tech giants while, and this is the important part, creating an entirely new structural opportunity for you.
Exactly. Because whether you hold tech ETFs in your retirement account or, you are just insanely curious about where the global economy is heading, understanding this specific structural shift is critical.
Definitely.
The era of just having blind faith in AI infrastructure is ending. We are entering this phase where the market is demanding a harsh reality check on every single dollar spent.
Well said. So let's start with what we're calling the Great Reversal. Let's look at the premier AI chipmaker at the center of this whole storm.
Let's do it.
Their Q1 2027 report was monstrous. Like I said, $81.6 billion in quarterly revenue.
Wow.
That is up 85% year over year.
It's just massive.
And the data center revenue alone, like the chips actually powering these massive AI models that hit $75.2 billion,
Right.
which is a 92% jump. And net income was $58.3 billion.
Just pausing there. $58 billion in pure profit. It's wild.
It's hard to even wrap your head around.
Mm-hmm.
Plus, they are rolling out their next-generation hardware platform, codenamed Vera Rubin.
Yep.
And they are aggressively expanding into the automotive sector, locking in deals with Hyundai, Uber, BYD.
Right. They're everywhere.
Everywhere. So by every traditional metric, this is a business firing on cylinders that shouldn't even exist. Yet, the stock slipped from an all-time high of $236.54 down to roughly $193.
Yeah. How do we even begin to square that math?
So the underlying mechanism driving that sell-off is a phenomenon that trading floors call valuation fatigue.
Valuation fatigue.
Yeah. We really have to look at the psychology of the marginal buyers here. Over the preceding 12 months, this stock had climbed roughly 50%.
Right.
And during that ascent, the market began pricing in absolute perfection. Investors weren't buying the stock based on what the company was doing today,
Right, they were looking ahead.
Exactly. They were buying it based on the assumption that every single best-case scenario for the next 5 years would execute flawlessly.
So meaning, by the time the earnings actually drop, all that perfection is already built right into the share price.
Right. And when a company actually delivers that perfection, well, you just run out of people to buy the stock.
Oh, I see.
If everyone who believes the optimistic outlook already owns the shares, an amazing earnings report doesn't bring fresh capital into the market.
It just sits there. Yeah, or rather, it just gives the people who rode the wave up a highly liquid moment to cash out.
Right. Buy the rumor, sell the news.
Exactly. But the sell-off isn't just about profit-taking.
Mm-hmm.
There's a deep structural anxiety here. We are starting to hear veteran analysts pull out the ultimate cautionary tale.
Which is?
Cisco in the late 90s, dot-com boom.
Oh, wow. Okay, I have to push back hard on that comparison, though.
Fair enough.
Because, people love to throw the Cisco.com analogy around whenever a tech stock runs hot. But during the dot-com boom, Cisco's customers were like Pets.com, and a bunch of startups operating out of garages with absolutely no revenue.
That's true.
When the venture capital dried up, those customers evaporated and Cisco's revenue just collapsed.
Right.
But today, this premier AI chipmaker is selling to Microsoft, Google, Amazon, Meta. These companies print billions of dollars in free cash flow every single month. They aren't going bankrupt. The buyer profile is totally different.
I agree. The buyer profile is very different.
Yeah.
But the financial loop might actually be more similar than it appears on the surface.
Really? How so?
Well, during the dot-com era, Cisco engaged in what we call circular financing. Telecom companies and startups bought massive amounts of Cisco gear.
Okay, yeah.
But those purchases were often funded by vendor financing, meaning Cisco effectively loaned them the money or by a closed loop of venture capital.
So tech was just funding tech.
Exactly, tech funding tech.
Are you saying Microsoft and Google are doing that today?
Well, look at the hyperscaler ecosystem right now. Yeah. Yes, Microsoft and Google have massive balance sheets,
Massive.
but they are also aggressively investing in AI startups. Those AI startups then turn around and use that exact investment money to buy cloud compute time from Microsoft and Google.
Oh, wow.
And then Microsoft and Google use that revenue to buy more physical chips from the hardware vendors.
Okay, let's unpack this. That is a closed loop.
It is. The anxiety Wall Street has right now is trying to answer a very hard question. How much of this massive AI spend is organic demand from end users like you and me paying for a monthly AI subscription? And how much is just a closed loop of tech giants and startups passing the same billions of dollars back and forth?
Okay, that paints a much more precarious picture. It's like planning the most extravagant wedding in history, right?
Yeah.
But by the time the cake arrives, the guests are already exhausted from the hype and just want to go home.
That's a great way to put it.
If it's a closed loop, the moment the music stops, the whole chain breaks.
But wait, Cisco's networking gear eventually did build the internet.
It did, yeah.
Is this a failure of the technology itself or just a failure of market timing?
It's definitely about timing and expectations. The technology is real, but to find out if the current demand is sustainable, to see if the stock price is just reflecting valuation fatigue or an actual stall, we have to look away from the stock market entirely.
Away from the stock market, where do we look? Institutional investors who want the real truth are currently obsessing over a hidden, real-time metric. It's called the GPU rental index.
Okay, let's break this down because this is the canary in the AI coal mine.
Absolutely.
When an AI developer wants to build a new model, they rarely buy the physical hardware outright.
No, almost never.
They don't buy thousands of GPUs. They rent that computational power by the hour from public cloud providers.
Exactly.
And there is a specific index that tracks the hourly cost of leasing a state-of-the-art B200 AI accelerator.
And the data coming out of that index right now is causing severe whiplash. Let's look at the timeline.
Let's hear it.
On May 30th, 2026, renting a single B200 GPU costs $6.11 per hour.
Okay, $6.
By June 21st, just 3 weeks later, that price plummeted to $4.22 per hour.
Wow.
That is a 31% drop in 21 days.
A 31% drop in 3 weeks is catastrophic for any pricing model. What is, like, the physical world equivalent of that?
The best way to understand this is to look at global shipping freight rates.
Okay, freight rates.
Yeah. In the physical economy, when the cost to rent a cargo ship spikes, it tells you global trade is booming. Manufacturers are desperate to move goods, so ship owners can charge whatever they want.
Makes sense.
But when those freight rates suddenly crash, it tells you the global supply chain has stalled. Goods aren't moving.
Right.
The GPU rental index is basically the shipping freight rate of the digital economy.
Oh, that's brilliant.
A 31% drop means one of two things. Either the supply of these chips have finally flooded the market and caught up to demand, or AI developers are actively hitting the pause button on their compute usage.
And traders are not waiting around for a quarterly report to act on this, are they?
Not at all.
We are seeing prediction markets, platforms like Polymarket and Kalshi pricing in this exact anxiety right now.
Yeah, heavily.
For those who don't know, on these platforms, people wager actual money on real-world outcomes. And right now, traders are giving the premier chipmaker stock a 62% chance of sustained consolidation around the $204 mark.
Right.
Even wilder, they are pricing in a 40% chance of the stock breaking below the psychological $200 barrier rather than reclaiming its highs.
And prediction markets are a critical tool here because they aggregate crowd sentiment from people who actually have skin in the game.
Yeah, real money on the line.
Exactly. And they often front-run traditional Wall Street analyst ratings. Analysts are notoriously slow to downgrade a stock because, well, they have corporate relationships to manage.
Of course they do.
Prediction markets don't care about relationships. They care about being right. So when they price in a 40% chance of a massive breakdown, it shows how heavily sophisticated traders are weighting that drop in rental yields.
But wait, let's play devil's advocate for a second.
Yes.
Is this sudden price drop actually a sign that the AI bubble is popping, or is this just the Osborne effect in action?
The Osborne effect.
Right, because we know the new Vera Rubin chips are entering production in the second half of 2026.
Yep.
If I know a radically faster, more efficient chip is coming out in 3 months, why would I sign a massive long-term contract to rent the current generation B200 at peak prices?
That's a very fair question.
It's like waiting to buy a new smartphone in August when you know the new model drops in September, right? Isn't this just an air pocket in demand?
The Osborne effect, where announcing a future product kills demand for the current one, is absolutely a factor here. The transition between chip generations almost always creates a temporary lull.
Right.
However, to truly answer whether this is just a product transition or a structural popping of the bubble, we have to look past the price of the rental
Okay. To what?
to who is actually buying the underlying hardware. And the data for the most recent quarter reveals a massive bifurcation in the customer base.
This is the shift from the check writers to the check cashers.
Exactly.
Let's define the players for everyone. The check writers are the hyperscalers. We are talking about Microsoft, Google, Amazon, and Meta.
The giants.
The absolute giants. These 4 entities alone have committed an unimaginable $750 billion in AI capital expenditures by 2026.
It's a staggering amount of money.
They are the ones pouring concrete, running power lines, and buying the physical chips. And then you have the check cashers, which are the hardware vendors supplying the whole ecosystem.
And the tension between those two groups is reaching a boiling point right now.
Why is that?
Because the shareholders of those check-writing hyperscalers are starting to demand a real return on investment for that $750 billion.
Show me the money, basically.
Exactly. The problem is, right now, consumer-facing AI is largely free or it is severely undermonetized.
Yeah, that's true.
You can go online right now and use a state-of-the-art multimodal AI assistant for absolutely nothing, or maybe $20 a month.
Right.
That doesn't even come close to covering the multi-billion-dollar cost of training it.
So the fear is that Wall Street is going to force the hyperscalers to slash their capital expenditures.
Yes.
If Google's shareholders say, hey, stop buying chips until you figure out how to actually make a profit, Google cuts its orders and the hardware vendors immediately collapse.
Right. And a year ago, that was the ultimate doomsday scenario.
Because a year ago, hyperscalers were buying almost all of the chips.
Yes. If a hyperscaler sneezed, the semiconductor supply chain caught pneumonia.
Right, right.
But the market hasn't fully digested a massive structural change that just occurred.
Here's where it gets really interesting.
Yeah, we call it the dual 50 shift.
Yeah.
A year ago, it was a monopoly of buyers. In the most recent quarter, it became a perfect 50-50 split.
Okay, so 50% of the hardware revenue is still coming from the hyperscalers.
Exactly. But the other 50% is now coming from a group categorized as ACI.
ACI. AI cloud providers, industrial enterprise, and sovereign AI. I want to zero in on that last one because sovereign AI feels like something out of a sci-fi novel.
It really does.
We are talking about literal nation states stepping in to buy hardware.
And it completely changes the geopolitical and economic landscape of the tech sector.
How so?
Countries like the United Arab Emirates, Saudi Arabia, and several European nations have realized that artificial intelligence is not just a software tool.
Right.
It is a matter of national security and fundamental economic survival. So they are taking their sovereign wealth funds and building their own localized national AI infrastructure.
But why do they need their own? Like, why can't Saudi Arabia just rent server space from Microsoft Azure like everybody else?
Because of data sovereignty.
Ah, okay.
These nations do not want their highly sensitive national data, whether it's citizen information, military logistics, or economic modeling, flowing through a data center located in California.
Right, where it's subject to U.S. laws.
Exactly. Subject to U.S. laws and corporate terms of service. They want physical sovereign control over the servers processing their data.
Wow. This fundamentally changes the risk profile for the hardware vendors.
Totally.
Because if a corporate hyperscaler like Meta has to pull back on spending to appease impatient shareholders, that's a problem for the chipmaker.
A huge problem.
But a sovereign nation doesn't care about quarterly earnings calls.
Not at all.
They operate on decades-long geopolitical timelines, so the risk is actually deeply diversified now.
Which brings up the obvious contradiction.
Right.
If the customer base is more secure, more diversified, and backed by the infinite wallets of nation-states, why did the broader semiconductor sector ETF, the SOXX, just suffer a brutal 10.4% plunge in a single trading session?
Exactly. If the foundation is actually getting stronger, what tripped the wire?
The wire was tripped by a domino effect of sector contagion, colliding head-on with a very unforgiving macroeconomic environment.
Okay, walk me through the contagion.
Well, the sell-off wasn't isolated to the premier AI chip maker. It bled into everything. Let's look at Broadcom.
Right, Broadcom.
They posted fantastic earnings. They beat top and bottom line expectations, but they maintained, rather than raised, their $100 billion full-year 2027 AI semiconductor revenue target.
Okay, so they just kept the target the same.
Yeah. And the market's reaction was a brutal 15% post-earnings drop.
Wait, why punish a company for hitting their goal? If they say they're going to make $100 billion and they're on track to make exactly $100 billion, why does the stock crater 15%?
Because in a high multiple growth sector, meeting expectations is viewed as a failure of momentum.
Seriously?
Yeah. The current valuations of these semiconductor companies are not based on linear growth. They're based on exponential acceleration.
Yeah, I see.
Investors are paying a massive premium because they expect the company to constantly raise the bar.
Doesn't they don't?
When Broadcom CEO effectively said, "We are sticking to our $100 billion target," the market interpreted that as a ceiling.
Right.
And when a stock is priced for infinity, a ceiling is terrifying.
Wow. And the contagion spread instantly from there.
It did.
Intel surged initially on the news that Alphabet was going to use them to manufacture their custom TPU chips, their tensor processing units.
Right.
But within hours, Intel bled out an 8.4% drop as traders immediately took profits.
Yeah, just brutal.
AMD fell 7.3%, completely unwinding an analyst upgrade that was tied to Meta's capital expenditure plans. It was an absolute bloodbath.
And we cannot look at this semiconductor contagion in a vacuum. You have to overlay the macro headwind.
The broader economy.
Exactly. The broader economic data slammed into the market at the exact same time as these earnings reports.
What specifically?
We had the May jobs report come in at a solid 172,000 jobs.
Okay.
And at the same time, the Federal Open Market Committee, the FOMC, held their meeting. And U.S. consumer inflation data showed it running hot at 4.2%.
Now, under normal circumstances, 172,000 people getting jobs is a great thing. A strong economy means people are spending money. But Wall Street treated this like an absolute disaster. Explain the mechanics there. Why does good economic news become bad market news?
It all comes down to inflation and the Federal Reserve's interest rates.
Right.
Strong job growth and 4.2% inflation mean the economy is running too hot. It means the Federal Reserve cannot cut interest rates.
They have to hold them.
In fact, it means they might have to hold rates higher for much longer than the market wanted. And high interest rates are absolute poison for growth stocks.
Break down the math for us because this trips people up. Why does a tech company stock price care what the Federal Reserve's interest rate is?
It's all about the discount rate.
Okay.
Think of a growth company's future profits like a winning lottery ticket that you aren't allowed to cash for 10 years.
All right, I have a 10-year lottery ticket.
Right. If inflation and interest rates are essentially zero, I might pay you $90,000 today to buy that $100,000 ticket from you because my money isn't doing anything elsewhere.
Makes sense.
But if interest rates rise, and I can get a guaranteed 5% return right now just by leaving my money in a basic savings account, that 10-year lottery ticket is suddenly much less attractive.
Right, because I have other options.
Exactly.
Yeah.
I might only offer you $60,000 for it today.
Because the alternative use of my cash is suddenly much more profitable without the risk.
Exactly. So to take that a step further, the mathematics of valuation use that exact logic.
Okay.
Analysts use a discount rate based on current interest rates to figure out what a company's future profits are worth today. As interest rates rise, the present value of those future dollars shrinks dramatically.
Wow.
The math is completely unforgiving.
So it's basically a perfect storm. It's like the market was a high-performance sports car driving at 150 miles per hour, and Broadcom refusing to raise its target was a speed bump, while the Fed's interest rate fears were a blown tire.
That is a perfect analogy.
The market aggressively de-risked. But while the main processor chips, the GPUs and TPUs that act as the brains of AI, are seeing this massive traffic jam, there is another piece of the hardware puzzle experiencing a historic boom.
Yes. This is perhaps the most underreported dynamic of the current AI infrastructure build-out.
Tell us about it.
Everyone focuses on the processors, the chips doing the actual calculating. But artificial intelligence
Right.
is completely starving for memory capacity.
Memory.
Right. You can have the fastest processor in the world, but if it doesn't have a massive pool of memory to hold the data it's processing, the whole system bottlenecks.
Ah, okay.
We are in the middle of a once-in-a-30-year memory supercycle.
And the metrics on this are wild. We are looking at DRAM contract prices surging by over 90% quarter on quarter.
90%.
NAND memory prices are up over 50%.
Yeah.
This isn't normal inflation. This is a market characterized by sheer desperate scarcity. Tech giants like Microsoft and Google are so terrified of running out of memory that they are signing unprecedented 3-year contracts with manufacturers.
It's just a guaranteed supply.
Exactly. They are putting down 10% to 30% advance cash deposits just to guarantee they get the chips.
And this completely upends the historical power dynamic of the semiconductor industry.
How so?
Well, historically, memory has been a notoriously cyclical, highly commoditized market.
Meaning what exactly?
Meaning a memory chip from one manufacturer was largely the exact same as a memory chip from another, which meant the manufacturers were price takers. They had no leverage.
Oh, I see.
Now, because the specific type of memory required for AI is so incredibly difficult to make, these memory foundries are dictating terms to the most powerful tech conglomerates on Earth.
Wow. Let's talk about why it's so hard to make, specifically HBM or high bandwidth memory, because this isn't the RAM you put in your gaming PC.
Not at all. High bandwidth memory requires physically stacking multiple DRAM chips on top of each other, like a high-rise building.
Literally stacking them.
Literally. And then running microscopic wires, they're called through silicon, vertically through the entire stack to connect them.
That sounds incredibly fragile.
It is. The engineering precision required is staggering, and the heat dissipation issues are immense. It is incredibly difficult to manufacture these at scale without a high defect rate.
Which explains why the companies that actually figured it out are raking in cash.
Exactly.
Micron, the American giant, is reporting the strongest profitability in its entire history.
Yeah.
Then you have SK Hynix, a South Korean firm holding a massive 57% global market share in HBM. And the crazy part is, SK Hynix has managed to push their manufacturing yields up to 80%.
Which is just an 80% yield on something as complex as HBM is a colossal manufacturing advantage.
Because it means less waste, right?
Yes, it means 80% of the chips coming off the line are fully functional and sellable. Compare that to Samsung. Samsung is traditionally the largest global player in sheer scale, but they are lagging behind SK Hynix in this specific HBM race.
Interesting.
They are pouring billions into R&D to catch up, but right now, SK Hynix and Micron own the high ground.
But this creates a massive downstream squeeze for everyday people, doesn't it?
It really does.
Because there are only so many silicon wafers available in the world. If SK Hynix and Micron are dedicating all their foundry capacity to making incredibly expensive, high-margin HBM chips for AI data centers, that means they are not making the standard cheap memory chips that go into our laptops and smartphones.
Right. The consumer tech market is effectively being taxed to subsidize the AI boom.
That's wild.
We are already seeing the fallout. Reports indicate that Apple is being forced to implement significant price hikes on their Mac computers and iPads.
Just for the memory.
Yep. Not because they radically changed the design, but simply to offset these soaring memory component costs.
This is the classic gold rush scenario. The people making the absolute most money aren't the ones panning for gold in the streams, like the software companies trying to build consumer AI apps.
Right. They're struggling to find a business model.
Exactly. The ones making the money are the ones selling the incredibly scarce pickaxes. In this case, the HBM memory required to make AI work at all.
Exactly right.
Which brings up a huge question for you listening to this. How do you even invest in this memory supercycle without putting all your eggs in one basket?
It is a notoriously difficult needle to thread for retail investors.
I bet.
If you want pure exposure to the memory supercycle, there are pure play DRAM ETFs available.
Okay.
The benefit there is high purity. You are buying exactly the trend that is booming. The downside is that these are highly niche funds with low liquidity,
Which means?
wider bid-ask spreads, higher volatility, and you are entirely exposed to the cyclical boom and bust nature of commodity memory.
Okay, so the natural pivot for most people is to say, I'll just buy a broad semiconductor ETF, something like the SOXX or the SMH. I get the memory companies, but I also get the broader sector stability.
That is the traditional approach, yes. But you have to really look under the hood at the fund's composition.
What's under the hood?
In those broad ETFs, memory giants like Micron make up a relatively small percentage of the total weight. Your exposure to the memory supercycle is heavily diluted by dozens of legacy semiconductor companies that might be struggling with macroeconomic headwinds or poor product cycles.
Wait a minute. If retail investors are buying broad semiconductor ETFs just to get in on this memory supercycle, aren't they unwittingly buying massive chunks of the exact same premier AI chipmaker whose stock we established is currently plummeting?
Yes, they absolutely are.
How does that dynamic actually impact the retail investor?
You've just hit on a systemic danger that flies completely under the radar.
Oh boy.
This is the mechanical reality of passive investing in a market dominated by a handful of mega-cap stocks. It creates a passive trap.
Okay, let's break down the mechanics of this trap. Because of how market cap weighting works, the premier AI chipmaker doesn't just live in specialized, aggressive tech funds.
No, it's everywhere.
It is deeply embedded in the everyday, boring retirement funds that millions of people hold blindly. It accounts for 13.1% of the Vanguard Growth ETF, the VUG.
Right.
It is 9.27% of the VanEck Semiconductor ETF, the SMH. And crucially, it is a whopping 7.88% of the Vanguard S&P 500 ETF, the VOO.
And when a single company makes up nearly 8% of the entire S&P 500, the feedback loops become very, very dangerous.
Dangerous how?
We enter what analysts call the algorithmic doom loop.
Walk me through a redemption. What actually happens mechanically when someone gets scared of inflation and clicks sell on their Vanguard S&P 500 index fund?
Okay, let's say 1 million retail investors see a bad inflation report, panic, and decide to pull their money out of the S&P 500 ETF. To give those investors their cash back, the ETF manager, which is really just an algorithm, has to sell the underlying stocks in the fund.
Right.
But the algorithm doesn't care about earnings reports or PE ratios or Vera Rubin chips. It sells mechanically based on the fund's weighting.
So because that one premier chip maker is roughly 8% of the fund, the algorithm automatically aims 8% of that massive selling pressure directly at that single stock.
Yes, exactly. That blind mechanical selling forces the stock price down.
Wow.
And when the stock price drops, it triggers automated stop-loss orders from institutional traders, which causes more selling.
A chain reaction.
Right. That further downward momentum scares more retail investors who pull more money out of the ETF, causing the algorithm to sell even more of the stock to cover the redemptions.
It's an endless loop.
It creates a downward spiral that is completely divorced from the company's actual business performance or future prospects.
So, what does this all mean? It's a self-fulfilling prophecy of selling. So, to combat that algorithmic panic, we have to do a fundamental valuation reality check.
We do.
Let's look at the actual math. At roughly $195 a share, is this premier AI chipmaker actually expensive? At this depressed price, the stock has a forward price to earnings, or PE ratio, of around 22x. It has a PEG ratio of just 0.44.
Let's pause and explain the PEG ratio, because it is the ultimate context metric here.
Go for it.
PEG takes the classic price-to-earnings multiple, but it divides it by how fast the company's earnings are actually growing.
Okay.
A PEG ratio of 1.0 means the stock is perfectly fairly valued relative to its growth rate.
Got it.
A PEG of 0.44 is astonishing. The market is essentially pricing this stock as if its growth is about to fall off a cliff.
Despite the company explicitly telling us they are expecting $91 billion in revenue next quarter.
Exactly.
And to put that 22x forward PE into context, let's look at their closest competitor, AMD. AMD currently has a forward PE of roughly 97x.
Right. And if you look at the premier chipmaker's own 10-year historical average PE, it sits around 54x.
So if we connect this to the bigger picture, by every growth-adjusted metric we use, the stock that everyone in the market is currently panic selling is actually trading at its cheapest valuation multiple in years.
But wait, what about the geopolitical risks?
Yes.
Because the U.S. government is actively tightening export controls, right? Cutting off this company's ability to sell their most advanced, high-margin chips to the Chinese market.
They are.
Doesn't that justify a massive discount on the valuation? If they lose China, they lose a massive chunk of global revenue.
That is a very real geopolitical headwind, and it absolutely dominates the financial news cycle. But if you read the fine print on the company's actual earnings guidance, the picture changes entirely.
What's in the fine print?
The company issued massive Q2 revenue guidance of $91 billion. When analysts drilled into the modeling for that exact number, the company clarified a vital detail. That $91 billion projection assumes absolutely zero data center sales to China.
Wait, zero.
Zero.
So the absolute worst-case geopolitical scenario, like a total embargo on the Chinese market, is already baked into the mathematical baseline.
It is fully accounted for in their forward models. That $91 billion figure represents their expected demand from the rest of the world, entirely exclusive of the Chinese market.
This brings us to a massive realization. Are retail investors essentially letting algorithmic ETF rebalancing? What a wild journey. Let's quickly recap the ground we just covered today. We started with the paradox of the greatest earnings report in history being punished due to valuation fatigue and fears of dot-com-era circular financing.
Yep.
We tracked the 31% crash in the GPU rental index, our B200 canary in the coal mine. We explored the massive bifurcation of the customer base, moving from hyperscaler monopolies to the rise of sovereign AI. We looked at the mechanics of the memory supercycle, understanding why HBM is so hard to make and how it's forcing Apple to hike hardware prices. And finally, we broke down the algorithmic doom loop of passive ETFs, revealing a company trading at less than half its historical valuation despite pricing in zero revenue from China.
It is a massively complex ecosystem, but understanding how these levers connect is the only way to separate market noise from structural reality.
Absolutely.
And I want to leave you with a final thought experiment to mull over as you watch this space evolve over the coming months.
Let's hear it.
We have spent this entire deep dive dissecting the physical hardware, the GPUs, the memory stacks, the data centers. But consider the long-term trajectory here.
Okay.
If AI compute power continues to get drastically cheaper, as we clearly saw with the GPU rental index dropping 31% in 3 weeks, and if sovereign nations continue building out localized infrastructure, treating AI compute as a subsidized, government-backed global utility,
Right.
then the ultimate financial winners of the AI revolution might not be the hardware builders at all.
Wait, really? Who wins if the hardware becomes a cheap utility?
The software layer. If compute costs trend towards zero, the ultimate winners will be the unknown software startups of tomorrow who will suddenly have access to unlimited, dirt-cheap supercomputing power to build applications we can't even fathom yet.
Oh, wow.
Are we staring so hard at the engine that we are completely missing the vehicle it is about to power?
That is an incredible perspective to end on. Thank you so much for joining us on this deep dive. Keep questioning the headlines, keep looking for the hidden metrics behind the math, and we will catch you next time.